So you might kind of be wondering, so if we compare that smartphone example that we looked at in the previous video to our pizza example, there's one key difference, right? So in the smartphone example, like I said at the beginning of the video, you might be tempted to kind of say, well, okay, the total revenue at the end is $30 billion. So that's similar to my pizza example, where the final good sold was the pizza for $10. So in this example, the pizza example, we found that GDP, or the contribution to GDP of the pizza, was $10, right? You could get that either by looking at the final good that we sold or by doing value added. They both gave you $10. In the smartphone example, this wasn't the case, right? The final amount sold was 30 billion, but the contribution to GDP was only 17 billion. And so there was a difference between the value added and the sale of the final good or service. So what is different between those examples, right? The difference is in the pizza example, all of the intermediate goods were purchased in that country, in the US. So they all contributed to the $10 of value in the final pizza, and so it all counted. In the smartphone example, only parts of that 30 billion in final sales was produced in the US. And so our job along the way in value added was to determine what was produced by US in the US and what was produced in another country. And so that comes down to what's produced here versus what is produced abroad or in different countries. Our formal terms for these are exports and imports. So exports are goods or services produced in the US, sold in another country, or sold abroad. So in the smartphone example, those $5 billion in rare minerals were sold from a US mine to someone in China. That is an export. It's produced in the US, sold in another country. So we counted that because it was produced in the US. Same thing is going to be true here, right? So exports, we want to count those as part of our US production because they were produced here. The other option, if it's not an export, it's an import, and that is a good or service produced in another country, purchased in the US. Right, so that would be an import, and we had lots of examples of imports in the smartphone production, right? So when we looked at the US smartphone company, let's say Apple, they had imports of $28 billion. So while they produced 35 billion worth of smartphones, 28 billion of that was imports, something produced in another country that we bought here. And we don't want that 28 billion to count as part of our GDP because we didn't produce it. We only produced this 7 billion in GDP, which was our value added. So value added is a very helpful idea to help us understand how exports and imports work in the process of GDP. Okay, so a few terms related to exports and imports. So one of the things that we look at in GDP, so I'm going to kind of calculate it as the sum of different expenditures. Net exports is simply my exports minus my imports. That tells me what my net exports are. There's several different terms we'll use to describe this. We will also call this the trade balance. Right? So it tells me how much do we send to other countries and how much do we buy from other countries. And so the trade balance tells me where those two are relative to each other. If the trade balance, net exports, is negative, we call that a trade deficit. So when you see me referring to a trade deficit, that means that imports are greater than exports, so that net exports is negative. Our trade balance is negative. If the trade balance is positive, we have a trade surplus. We are exporting more than we're importing. So those are some of the terms that we use to discuss our trade with other countries. Exports minus imports. When that's positive, it's a trade surplus. When it's negative, it's a trade deficit. Okay, so we've got a bunch of other stuff here that I'll just kind of describe briefly that goes into calculating GDP. So if I wanted to calculate GDP with the expenditure approach, what are the different categories? Well, consumption is personal consumption expenditures, which is consumption on the normal household things that you're thinking of. So if you buy a shirt, you buy a sandwich, clothes, and you buy appliances, a car, all of those things would go into what we call consumption. And that's, a bulk of our GDP. So it's about 70% of our GDP is in consumption. The other one, investment. So I'm going to flip here if I can to a note here to talk briefly about investment. Now, this investment is not what you typically think of as investment. When you think investment, you think I bought a stock in a company, and so I'm investing. In economics, or at least in macroeconomics, what we mean by investment is businesses buying what we call capital. And capital is equipment, buildings, machines, etc. Right? So businesses buy stuff. So for example, if I buy a cement mixer, so I'm a construction company. I buy a cement mixer from Oshkosh Corporation. That counts as an expenditure. We put it in investment, right? It's businesses buying capital. So that's the main component of investment. There's also the inventory business that we talked about. That would show up as investment. So if a company stores some of their production in inventory, that goes as investment. And there's also called residential investment, which is houses. So when you buy a house or you build a new house, that's going to count as part of investment spending. That would not be consumption expenditures. Okay, so one more here on this video, which is government expenditures would count as part of GDP. So let us, just briefly discuss government expenditures. At least what counts towards GDP is going to be if I buy a good or a service. So purchases of goods and service, and this includes local, which are like your city of Oshkosh, state, and federal government. Right? So any level of government that buys a good or a service, that counts as a government expenditure. So, if we build a road or we build a new school building or you buy supplies for the school building, right? That all counts as government expenditure. This excludes any transfer payments. Those would be, say, Social Security checks, any other type of, earned income tax credit, those types of things are transfer payments. So I'm moving income between different parts of the economy, but I'm not buying a good or a service. And so that won't count. So when we say government expenditures as part of GDP, we don't mean total government spending. We're only calculating production. So we just want to know what the government bought. So if they buy an airplane, that's going to count as part of government expenditures. If they send grandma and grandpa a Social Security check, that doesn't count as part of GDP. That's a transfer of income. When grandma and grandpa spend the Social Security check and, food, that will then show up as part of consumption. So we don't want to double count the transfer payments. Okay, so it's a pretty quick tutorial on what's included in the expenditure approach. And in my next little video, I have just kind of an example to walk through how we might use that information to calculate GDP.